Welcome back. Today we're looking into a market that, on the surface, just looks like an absolute goldmine, a perfect spot for a digital business.
Mhm.
And yet, our data shows it's one of the hardest places in Europe to actually, set up shop.
It really is.
We're talking about the high-stakes, high-barrier world of iGaming in Spain.
That's right. And we had a listener ask us to analyze this, and it's a fascinating contradiction. You have this massive, stable, regulated market. The consumer metrics are fantastic.
Absolutely top tier.
But then it carries this surprisingly low score for operational ease.
And just for context, we're the Gambling Databases research team. Our whole job is to deliver these in-depth, data-driven analyses of the global iGaming landscape.
Right. And every country report we do, we look at everything: the local regulations, tax, the player experience, what it's like for operators, and any new trends.
So our goal today is to give you a really clear, data-driven picture of how the gambling industry actually works in Spain, what makes it so unique.
And it is unique. It's a market that promises big returns. I mean, we're talking about high player value, fantastic digital infrastructure.
But the cost of just getting to the starting line and then staying in the race is just staggering.
So let's set the stage. Just look at the raw potential. Spain has a population of what, around 47 million people based on the 2025 estimates?
And they are extremely online.
Oh, completely. Internet penetration is at 92%. Mobile is right behind it at 89%.
That is an operator's dream, isn't it? You don't have to teach anyone how to use the tech. They're already there, they're fluent, they're connected.
And the market size shows it. We're looking at 1.6 billion in revenue this year. And it's projected to grow at about 8% a year through 2028. Those are stellar fundamentals.
They absolutely are. So that brings us to the big question, the paradox.
Exactly. We assess a market on two things, really: the strength of the consumer, which is excellent here, and the ease of operation for the business.
And despite these amazing consumer numbers, our analysis gives Spain an operator ease score of only 5.2 out of 10.
Which is low. That score tells you the business environment is, well, it's intensely hostile to anyone new.
Okay, so let's unpack that. Why is a market with such a valuable, ready-made user base so incredibly difficult to get into? It has to start with the rules.
It does. It all starts there, in what we call the regulatory crucible. This is the first and honestly the most critical barrier. Spain operates under this really comprehensive framework. It's all governed by the DGOJ.
That's the Dirección General de Ordenación del Juego.
Right. And the main law, Ley 2020-11, it regulates every single online vertical: sports betting, casino, poker, bingo, everything.
And what's so interesting here is that the stability, the fact that it's so clearly regulated, is kind of a double-edged sword.
It is. I mean, unlike some of those gray markets where the law is murky, the Spanish framework is crystal clear. It's legally binding. For a huge global brand, that's actually a major strength. They know the rules.
And they know the rules aren't going to suddenly change overnight.
But that certainty comes at a price, and it's an exorbitant price. First, just the license itself. The initial fees are somewhere between 150,000 and 250,000 euro.
And that's just the application fee, basically.
Pretty much. And the process to get it approved takes between 6 and 12 months. So that's the first check you write, long before you've even hired anyone.
Then comes a part that I think is even more crippling, especially for smaller companies: the mandatory local presence.
This is non-negotiable. An operator must have a local Spanish office. They have to employ local staff, and their domain, their Data's domain, has to be registered and hosted in Spain.
Which kills the whole remote license model, right? The one that's so common in places like Malta or Gibraltar, where you can run your whole operation from somewhere else.
It completely eliminates it. Spain is sending a very clear signal. They're saying, we want you here in our country, contributing to our economy, paying local salaries, and operating right under our noses.
But couldn't you argue that's a good thing? I mean, more jobs for Spain, better consumer protection. Is that really a net negative for the operator?
Operationally, yes, because it locks in huge fixed costs from day one, whether you're making money or not. And it forces every single technical decision to comply with DGOJ standards. And those standards are demanding.
Speaking of demanding, let's talk about the tech. You mentioned this vault system requirement. For someone listening who isn't a systems admin, what is that? Is it basically a black box for the regulator?
That's a great way to put it. A vault system is mandatory software that sits right between the operator's platform and the DGOJ.
And it just watches everything.
It does more than watch. It's real-time monitoring and recording of every transaction, every bet, every deposit, every single player interaction. The regulator sees it all as it happens.
So they have instant, totally transparent access to the guts of your operation.
Precisely. And while that ensures compliance, it also means these rigorous, expensive technical audits to get set up, and the systems themselves are costly to maintain. It's just another layer of cost you don't face in other markets.
And the DGOJ actually enforces this stuff
Yeah.
aggressively.
Oh, yeah. We see it all the time. If an operator slips up, especially on things like responsible gambling or the advertising rules we'll get to later, the penalties aren't just a slap on the wrist.
We're talking massive fines.
Well,
And they could just pull that license you spent €1.25 million on.
it's a very, very high-stakes environment.
Okay, so we've established the barrier to entry is just, well, it's immense. So why do the big global players still fight so hard to get in and stay in?
Because of the prize, the Spanish consumer. Which brings us to the second part of our analysis.
This is where the numbers start to look good again. You've got a highly urbanized population, about 80% living in cities, with really advanced digital literacy.
And mobile is absolutely king. With 89% of people on smartphones, that's the main battleground. That's where you have to win.
And people there, they like to gamble.
They do. Over 70% of adults in Spain gamble in some form annually. Sports betting is the most popular at 42% participation. Then you have lotteries at 35% and online casino at 28%.
And they're used to paying for things online. They use cards, e-wallets, and those local instant transfer apps like Bizum are taking off.
All of that is great, but the number that makes everyone's ears perk up is the ARPU, the average revenue per user.
And it's a big one. It's a robust €200 per month. That's significantly higher than a lot of other regulated European countries.
It reflects a really strong cultural acceptance of gambling as just a form of entertainment, plus high spending power. This player is extremely valuable.
And yet, there's always a but with this market, isn't there? That high ARPU figure hides a huge problem.
It does. It hides the crucial friction point that dramatically lowers the lifetime value, the LTV, of those very players. And that is player taxation.
This is such a stark contrast to a market like the UK, where winnings for most players are just tax-free.
Exactly. In Spain, the player is legally required to declare winnings over a certain amount on their personal income tax.
So if you win big, you get a big tax bill.
Right. And for non-residents, there are withholding taxes that can hit 20%. So the second a player has a significant win, they face this legal and financial headache. And what happens then?
The VIPs leave. I've mentioned it, but let's really think about that. How important is that high roller, that VIP segment, to an operator's bottom line?
It's everything. Historically, in iGaming, the top 5% of your players can generate 50% or more of your total revenue. They are the profit engine.
And when those players know they'll be taxed on their winnings with a licensed site.
But they can go to an offshore, unregulated site and keep everything. The incentive to stay is just gone. They leave immediately.
So you invest €500,000 to get a license, spend a fortune on local staff and compliance, just to lose your most valuable customers to the illegal competition because of your own country's tax laws.
It creates a ceiling on your profitability. The average player ARPU is great, sure, but losing those high rollers just crushes your long-term margins.
Which leads us perfectly into our third section, the reality check. This is where all these costs and all this friction combine into what we call the financial squeeze.
Let's start with the operator's tax bill, which is just relentless. It's multi-layered. First, you have the gross gaming revenue tax, the GGR tax.
So that's a tax on all the money wagered minus the winnings paid out.
Correct. And it's 25% for casino games and 20% for sports betting.
25% is high. I mean, you look at a market like Sweden, it's a flat 18%. Spain has already taken a huge bite before you've even paid your rent.
And that's just the beginning. On top of the GGR tax, you pay standard corporate income tax, which is another 25%.
Wait, so your revenue gets hit twice?
Twice. And then you have the fixed annual license renewal fees, which are another 100 to 250,000 euros every year, whether you're profitable or not.
Let me just do the math on that for a second. So I pay 25% GGR. Then I pay 25% corporate tax on whatever profit is left. When you add in the fixed fees, what's the effective tax rate on revenue?
The combined impact pushes the effective tax rate to somewhere between 45% and 50%. You are essentially splitting your revenue down the middle with the state.
Okay, so you're operating with a 50% tax rate. You've got mandatory local staff, expensive tech, and you've lost your VIPs. How do you even attract new customers?
And that is the single biggest challenge, what we call the marketing straitjacket.
This is where it just gets absurd.
It really is. The DGOJ has severely, and I mean severely restricted advertising, especially broadcast ads. You are limited to this tiny, useless window in the middle of the night.
It's 1.00000 a.m., right?
That's right, 1 to 5 in the morning.
How can you build a brand if you can only advertise when literally everyone is asleep?
You can't. Not in a traditional sense. And that's the point. The market is already saturated. There are over 50 licensed operators. All the huge names are there.
Yeah.
Bet365, Limwin, 888, they're entrenched.
So a new company can't just come in and buy market share with a big ad campaign?
Impossible. It forces them into these incredibly expensive and less effective channels. Targeted social media, SEO, sponsorships.
And that just blows up your customer acquisition costs, your CAC.
Precisely. The SAC often goes over €250 per player. Now think about that. You spend €250 to get one player whose average monthly value is €200, which you're already splitting 50-50 with the government.
You'd need that player to stay active for months and months just to break even on acquiring them.
Many months. Forget profit, just to break even.
And this is where it all comes together. We see why that operator E score is a 5.2. It's a graveyard for startups, as one of our sources put it.
Let's look at the final viability numbers. The initial investment, all in, is probably between €400,000 and €600,000 just to open the doors.
And because of everything we've just discussed, the time to break even is 24 to 36 months. 2 to 3 years of just bleeding cash.
Which is significantly longer than pretty much any other major European market.
So the verdict is pretty clear. This market is only viable for huge, well-capitalized operators who can afford to lose money for 3 years straight.
We recommend anyone even considering it have at least $5 million in funding ready to burn through just to survive that initial phase.
It's all about preservation for the existing players, not creation of new wealth for newcomers.
Exactly.
So let's bring this all together. Let's summarize it with our 2 core scores.
On one side, you have the player access score. We rate that a very high 8.5 out of 10.
Because players get a great deal. Lots of competition, great tech, and really strong consumer protection from the DGOJ.
They're very well looked after. But on the other side, the operator E score stays at that low 5.2 out of 10.
Because of the high costs, the local presence rules, and that marketing straitjacket that makes it almost impossible to grow.
So our conclusion is that Spain is the ultimate pay-to-play market. It offers incredible stability if you can afford it. But that price for entry is just exorbitant. It's reserved for the Tier 1 global brands.
Which brings us to our final thought for you to consider. And it ties right back to that theme of enforcement. Given the DGOJ's aggressive history and Spain's active extradition treaties with the US, the UK, Canada, what deeper implications does all this international cooperation have for the directors of, say, non-compliant or offshore operations targeting Spain?
That's the hidden value, isn't it? That high regulatory wall, while painful for licensed operators, also protects them. It means the Spanish authorities are actively using international law to go after the unlicensed competition. It makes you think twice about who is really taking the risk when regulations are breached across borders. It shows you what that stability you paid so much for is actually worth.
A really essential thought when you're assessing risk on a global scale. We hope this analysis is giving you some clarity on the unique landscape in Spain. For the full text of this and all our other country reports, you can visit our website at gamblingdatabases.com.